Welcome to Kaiser Watch with John Kaiser. I'm your host, Jim Goddard. Welcome back to the show, John.
Jim, pleasure to be back on the show.
John, the IMF published its semi-annual World Economic Outlook this week. Did anything catch your attention?
Well, Jim, what I look for in the IMF data set is the annual GDP figures presented in current U.S. dollars, for which the IMF also provides forecasts for 2022 through 2027. Now, the problem with this data set is that not only does the IMF have to predict what the GDP growth will be in the national currencies of every country, but it also needs to guess what the domestic inflation rate will be, and then it needs to guess what the currency exchange rate for the U.S. dollar will be in order to come up with these numbers. So this year's numbers are probably pretty reliable because they have all the data feeds for that, but projecting into the kind of tumultuous future that we are facing. I mean, just look at what happened in the United Kingdom when the new Prime Minister, Liz Truss, came up with this great idea of subsidizing people's higher energy costs due to the Russian blackmail with regard to natural gas in Europe. And at the same time, let's do some trickle-down economics and give the 1%ers a major tax cut so that the revenues that are coming in that are supposed to pay for the subsidies for the 99%ers just don't happen. And you have tremendous turmoil in the British bond market to the point where the British central bank has had to step in several times to soak up all these debt instruments that these pension funds under their various rules are suddenly forced to liquidate. So we're heading into a crazy future where the threat of inflation and higher interest rates create a lot of instability. But that aside, the IMF does its best to come forth with these projections. And so I take a look at them and try and guess, what does this mean for, say, super cycles, macroeconomic trends that affect our resource juniors? Now, for this year, they project that the GDP will be 104 trillion, of which the United States at 25 trillion is about 24%. China at 20.3 trillion is in 19.6%. Japan and Germany take third and fourth place. And India has 3.5 trillion, which is about 3.4% of the total GDP. Now, what I find interesting is that in these projections, the IMF expects China's economy to continue to grow 6.8% over the next 5 years, while America's growth is supposed to sag below 4%. If you follow those projections, by 2027, total GDP is projected to be up 29% at $134 trillion, of which the U.S. GDP will be about 23%, while China is 21%. The convergence of these two economies as expressed in the current U.S. dollar format, this is now coming even closer than the 2030 that was originally expected. I do have my doubts that the IMF is correct about China's 6.8% growth rate. This year, China's growth rate has dropped below 4%, and a key part of the problem is Xi Jinping's decision to turn the zero COVID policy into a symbol of the superiority of autocracy over democracy. And he has used it as an excuse to create a hyper-surveillance state in China where everybody is being monitored all the time for the sake of their health. Now, COVID at this point, the current variant, is nowhere near as lethal as the Alpha and Delta variants that started in 2020 and roared into 2021. So it is kind of crazy to keep shutting everything down. And today I read in the newspaper, Shanghai has detected 43 new cases, and so that major city is once again bracing for a huge lockdown. I think Xi Jinping has made a strategic blunder with his decision to make the zero COVID policy this important symbol. This month he is expected to be confirmed for a third term, unprecedented. he becomes the supreme leader. He envisions himself as the second coming of Mao Zedong. But I think this problem with continuing to shut down this economy every time somebody gets a sniffle that happens to be COVID, I think this will seriously hamper China's growth prospects. The China super cycle is over. People are unhappy. China has a significant demographic problem thanks to its one-child policy that prevailed for decades. It has been eliminated. But with all these constraints on the ability to live, to enjoy life, Chinese people aren't in any mood to bring more children into the world. So China has this longer-term demographic problem, which India does not. In fact, India has about the best demographics in the world, and it has the second largest population. What I found interesting about the IMF projections is that it expects India's GDP to grow 8 to 10% annually over the next 5 years. That would translate into a 54% growth from 3.5 trillion to 5.4 trillion by 2027. Now, this pales in comparison to the 25 trillion of the United States, but it brings India very close to a super cycle tipping point, because all these other nations, China, Japan, Europe, even the United States, they all have demographic problems that will hamper their growth ability, but India does not. So I think by 2030, India will finally reach that tipping point where it could create the next super cycle that will scale up raw material demand well beyond current levels, which are sort of pretty much matching the macroeconomic growth trend that the world is on right now. Now, this is going to be a problem for India because it provides 5 to 10% of global supply for only 7 raw materials. Those are in order of percentage: coal, iron, chromium, bauxite, zinc, aluminum, and alumina. And 3 of those, alumina, bauxite, and aluminum, they're all related. So India is self-sufficient in aluminum. But all these other metals, it is way below 2% in most of them. So it's going to be a serious importer. Now, the big obstacle for India is that it has an entrenched bureaucracy and no lack of corruption, which keeps things from happening. But there does seem to be an awakening, and India has done better in the past couple years than expected after being totally hammered with COVID, the Delta variant, in the first half of 2021. But again, from a Resource Junior perspective, it is going to be 2030 and beyond before the super cycle kicks in and gets the juniors scrambling the way they did in that 2000 to 2010 period when China hit that trigger point and started to grow substantially.
John, nice to see India getting its act together, but will the junior resource sector still be around by then?
Well, I see 2 key reasons why the resource juniors will remain relevant over the next 8 years, and neither of them involve gold. Now, this was another volatile week for the market thanks to the latest inflation data for the Consumer Price Index. Although the CPI is still 8.2% year over year, it increased only modestly in September from August. But when you strip out the food and energy components and just look at the core CPI, the month-over-month increases remain above 0.4% with 6.63% year over year. Energy prices, gasoline prices, that did retreat during the summer, which was unexpected, and that has helped the main CPI index from charging higher. But it is the core CPI which has Jerome Powell worried that he's not licking this inflation trend. So the market is expecting further interest rate hikes, and this because of the lag effect in terms of consumer response to higher interest rates, there's a growing concern that we are heading into a significant recession because the economy is like a super tanker. It responds slowly to factors such as higher interest rates, But even when suddenly you realize you've created a mess, the economy's stalled, just dropping interest rates overnight do not make the economy resume its uptrend. And that's a reason gold is sinking down right now. I prefer to look at gold exploration plays where you might deliver a discovery with grade and scale that works at $1,200 to $1,400. That's where the price of gold ended up stuck during the 2010 to 2020 period. It was during that period the Tea Party gained control of Congress and pretty much prevented Obama from engaging in any fiscal stimulus to move the economy along. It was all left to monetary policy, quantitative easing, print a lot of money, soak up all this paper, and not really grow the general economy, just grow the wealth base of the 1%, if you wish. But this time around, I'm more interested in the problem of the China-Russia axis that has emerged in the wake of the Russian invasion of Ukraine. When you look at where all the raw materials come from in the world, and you combine the China and Russia figures, it is terrifying to see how much comes from that part of the world. And Russia really has no exit at this point. It has become a pariah nation. It has murdered people. It has raped people. It has destroyed a country. It is basically declared the Ukrainians have no legitimacy as Ukrainians. They are all just Russians. And there is just no way to resolve this in any way. You can't turn the clock back. And so this problem with the Ukraine, it's not going to go away. And when you look at where Russia stands in terms of military spending, last year in 2021, the world spent just over $2 trillion on defense budgets. Now, the United States had $800 billion of that, representing about 38.5% of it. China was in second place with $293 billion for 14.1%. India was there at $77 billion, and then Russia comes in at $66 billion. And Russia, in terms of global economy, it's in ninth place after Canada. Its economy represents only 2.1% of global GDP this year, and yet it spent 3.7% of its budget of its GDP on military expenditures, which it's starting to use up all its hardware. And since nobody's really want to ship them anything at this point except perhaps China, Russia may have its own problem keeping itself outfitted. Now, the United States spends 3.5% of GDP on military, but that's 12 times as much as Russia spends on its military. So unless the world wants to just hand Ukraine over to Russia and appease him so that he doesn't use nuclear weapons on anybody, and that appeasement is going to work as well as it did in the 30s. The next threat from the megalomaniac will come along. It'll be Estonia, Latvia, Lithuania, maybe Poland. Maybe Viktor Orban will say, yeah, I'm a perfect Putin poodle. Let's just make Hungary part of Russia again. If the world resists this and eats the consequences of the energy price hikes that are going to come from having no Russian gas and limited Russian oil, Russia will lose its campaign in Ukraine, be chased out, be told you've got to repair all this, you've got to fix it, and it will end up simply huffing away and joining forces with China. But as I mentioned earlier, China itself has its own issues with a demographic problem, with its zero COVID problem, and a growing unhappiness as the people end up caged into their homes and not allowed to do this or that. So I'm not so sure how well this Russia-China alliance will work, but I think it will constrain the availability of all these raw materials that we've taken for granted in the world of globalized trade. All of a sudden, trade is no longer globalized, and so the Canadian juniors starting to look for these materials that came from these lower cost jurisdictions where they don't really care about workers' health rights or emission controls. I think this is going to become more and more important, and unlike gold, which nobody really needs anymore, ounces of a lot of these raw materials are critical, and chief among them is lithium, and that's the other reason that I think the juniors will stay relevant. It's possible that China gets off its zero COVID policy, starts to open up, Xi Jinping gets bounced out, and they start focusing on actual prosperity, and perhaps Putin gets bounced out, and Russia says, why are we screwing around with all this megalomania stuff? We've got this resource-rich country. Let's just be a producer and use the latent talents of our people to diversify the economy so it isn't just a pack of oligarchs who benefit from the raw material extraction. Maybe all these good things will come to pass and we won't need a huge amount of new raw material from safe jurisdictions. And in that case, we will still, however, need lithium for the energy transition as far as the emergence of EV, electrical vehicles, is concerned.
John, why are you so keen about Lithium Mania 2.0?
Well, the projections coming now from places like Benchmark and Rio Tinto is that based on the sort of current battery configurations, by 2035, the world will need roughly 10 times as much more lithium supply as it is getting now. Last year it was about 100,000 tons of metal equivalent at the average lithium carbonate price of $15 a pound. That translated into $18 billion. At this year's $30 price, that same amount of production would be worth about $36 billion. That starts to become a pretty serious number. And if you go back, just let the price go back to $10 a pound, where a lot of lithium projects do work, new supply can come on stream. We're talking about, scaling up supply 10 times. We're talking about a future $100 to $200 billion a year market. Last year's gold output at its average price of $1,600 or so, that was $150 billion of metal supply. 100 to 200 billion is big leagues for raw material production, and what the big guys are now seeing is all these rules, such as no new ICE car sales in California by 2035. If that all sticks, we're going to need a lot more lithium. And making all these rules has the benefit that the governments are now forced to look all the way upstream to where are all the inputs coming from, and also electricity grid distribution, and when these for all this extra electricity demand that will come from no longer filling your cars with diesel or gasoline, they're going to have to make sure that they have that power infrastructure in place, but also the delivery infrastructure so that the grid can handle the delivery of this. And where's all this lithium going to come from? Well, a lot of it's going to come from the lithium triangle in South America, Australia, Western Australia, the pegmatite deposits. They responded so well to Lithium Mania 1.0 in 2015-17 that they overshot what the car industry actually needed by then, and it caused the lithium price to crash from $10-15 a pound back below $3 a pound, where none of that worked. But since then, the demand has caught up, and the infrastructure development, because of that lag about, I guess we really don't need so much lithium, all of a sudden we have a higher price than is really necessary to mobilize new supply. And where's this new supply going to come from? Well, China's doing its best to mobilize its own brine deposits and its lepidolite style pegmatites, but I don't think that's going to be anywhere near as successful as it has been in Australia. So the place to look at is other Archean settings like Eastern Canada, Scandinavia, Brazil. Look for these lithium, cesium, tantalum enriched pegmatites. Many of them were found and documented ages ago, but ignored because the lithium market was tiny, only a couple $1 billion a year, dominated by a few giant deposits, Greenbushes and Burnick Lake, and the the Chilean salars, the brines that came on stream there. That took care of the world's needs, took care of the world's laptop and cell phone battery needs. But the demand created by the lithium-ion-based electric vehicles, that is an order of magnitude bigger after already undergoing a order of magnitude of demand expansion. And if you're going to have these EV explosion in 2030 and beyond, you need to act right now. So I see as a huge boom to keep the resource juniors alive is going into Eastern Canada, finding these pegmatite trends, peeling back the moss, doing some grab samples to make sure it's enriched, put some holes across, assess the purity, delineate it, can be done fairly quickly. The governments and the various provincial governments in Canada are all behind setting up lithium hydroxide facilities so that you can take the spodumene concentrates and convert them into the battery-grade lithium hydroxide or lithium carbonate that the battery makers require. And because of the speed with which you can delineate a pegmatite and figure out what its flow sheet's going to be, this is an opportunity for stocks to go from, say, a $5 million valuation to $500 million valuation, a 100-bagger. We're going to see this sort of dynamic invade the market. It's having a tough time getting going in the current environment, where the other day we had this 10-cent company, Core Mining, which has some U.S. gold prospects. All of a sudden they decide to do an $850,000 rights offering at a penny. They claim, it's a nice deep discount. Nobody should complain except for American residents who can't participate in this rights offering. They take an instant 90% bath. And apparently Eric Sprott wasn't particularly impressed. He blew out his entire position the day after the news came out and then discovered that he probably shouldn't have done that since he owned more than 20%. But this type of example, this market has become very stressed in terms of fundraising, and companies are doing almost anything to get money in the bank because there is this fear and loathing about this recession, global recession that is coming that will wipe out capital flows. But the car companies, they're screwed. They've gone beyond the point of no return. They have to build these electric vehicles. The policies are in place that are forcing them to do it, but they've already made a decision to do it anyways. The energy transition is happening. Russia and Saudi Arabia ganging up to screw it to consumers. That only helps the cause to let's get away from this fossil fuel dependency where you have these nut bar thug type nations injecting their ideas on that and disrupting our lives. Let's move on with the energy transition. So the context is right to keep supporting it. And I think the lithium juniors, the big pegmatite hunt, Lithium Mania 2.0 I call it, I think that's going to carry the day for the juniors over the next few years because there is a huge pool of capital in the wings, in the hands of the car makers, the battery makers, all these other parties who are now figuring out that you need this tiny input of lithium to make their EV replacement of ICE dreams reality.
How does one get up to speed on juniors that benefit from Lithium Mania 2.0?
Well, through Kaiser Watch, we'll be talking about various lithium companies as we turn them into favorites. But for now, I don't have any favorites that I'm openly talking about. I have gone through the whole system of companies and found all those that claim to be involved in lithium exploration. Many of them are very cheap, blown up companies with a couple 100 million shares out, trading at 5-7 cents, where I'm going through them all now, finding which ones have a meaningful land position, have competent management that understands how you explore for lithium pegmatites. And the one that I have talked about publicly because it was part of my Metals Investor Forum, it's Brunswick Exploration, which is Bob Wares. He's the major shareholder in this, and they have been picking up projects in Eastern Canada, in Ontario, Quebec, Nova Scotia, Newfoundland. Their method is to go through the archives, look at all these documented showings in the past, go check out the areas, put boots on the ground, see if the mapping is correct for the geology, find out where these LCT-enriched pegmatite trends are going to be. They'll never be within the main S-granitoid. They'll be on the edges of it. They'll have bled out from the original intrusion. Find where these trends are, stake them, peel away the moss, take a sample, shoot them with an XRF gun to see if there's rubidium in them, and then get them assayed, and then if the footprint's large enough, drill them. I think we'll see a lot of projects at the drill-ready stage in the early part of next year. And right now, my Kaiser Research members, we're busy accumulating a stock that's below 5 cents. It's in Quebec. We don't know yet that they have a pegmatite trend, but it is an interesting story where they owned this ground before when it was part of a gold project. They did all the grunt work, found there were just these white pegmatites there that were of no interest, let that drop, and then they come back and the government's just published a lake bottom sediment survey which shows rubidium values in this area of these pegmatites. So good chance these are not the barren pegmatites that you don't want, but the LCT enriched ones. So this is one, if they announce that we have confirmed these are pegmatites, there's a stock 4 cents that could suddenly be a 10-bagger just to reflect exposure to a pegmatite field that had not previously been recognized. And I think we'll see this repeat itself over and over again, and I'm really looking forward to next year, even if it's a horrible bear market for the resource juniors, because this Lithium Mania 2.0 space, it will march by its own drummer. The participants won't care what's going on in the big picture, and there'll be a lot of 10, maybe even 100 baggers to be made paying close attention to this sector.
John, thank you so much for the update.
You're welcome, Jim.
We've been talking with John Kaiser. I'm Jim Goddard. Comments made on Kaiser Watch are an expression of opinion only and should not be construed in any manner whatsoever as a recommendation to buy or sell any financial instrument at any time. Archived online at kaiserresearch.com.